Hi, David Bassanese here, Chief Economist at BetaShares, and this is a snapshot of my market trends report for the month of February. The year so far has started off on the back foot. The global equity market over January down 6.1%, and really essentially on the back of fear of US interest rate increases. The Federal Reserve over there does seem hell-bent on raising interest rates several times this year, given the relatively high inflation numbers that they're still getting. Partly COVID related, but also it's true that the labour market in the US is quite tight, and wages growth at the moment is also running at pretty high levels. So the Fed, I think, is intent on starting to raise interest rates, and that's looks like it's going to continue to put downward pressure on the equity market, given the still relatively high PE valuations in the US market. The Australian market wasn't spared. It was down 6.4% in the month of January. So although our central bank is still talking about not raising rates anytime soon, as is typical when the US sneezes, we catch cold. So our market is likely to remain caught up in the volatility being driven by the US outlook. What we also saw in the month was an unwinding, with bond yields going higher. So US 10-year bond yields through January rose about 27 basis points, up to 1.78%, and higher bond yields continuing to see investors move out of technology stocks, particularly high valuation stocks with not a lot of earnings, and moving into more of the value parts of the market, such as financials and energy stocks, which actually went up over January. So I think with the Fed looking to raise rates, bond yields, I think, continuing to go higher over the next few months, we will see a continuation of the so-called growth to value rotation within global equity markets. And I think the Australian market is also going to remain under somewhat pressure. So it's probably premature to think we've seen the lows for the market at this point, just given the Fed haven't even begun to raise interest rates. But at this stage, I don't see a recession in the US, so I don't see a significant bear market beyond, say, a 10 to 20% decline in the market. The market has been off around about 10% at its low so far, and it may fall somewhat, may even fall 20% over the next few months. But much beyond that, you would need to see a US recession, which at this stage does still look unlikely. That's pretty much the outlook for now. We'll see, how things progress. But it's a more of a cautious outlook on the back of what seems to be the beginning of a Fed tightening process over the next few months. Thanks for listening, and I will. If you'd like to see full details of my market trends report, please visit the insights section of our website, and I'll see you again next month.